A lot of information to digest for the market, for investors. One of those is James Gerrish from Shaw Partners and Market Matters, and he joins me now. James, welcome. Good morning to you. So we're getting, as expected, trading updates coming from this Macquarie conference. I would like to start with JB Hi-Fi, particularly because we saw the Reserve Bank lift rates again yesterday. That will, gotta think, continue to knock demand on its head.
Yeah, good morning to you, Nadine. You're not wrong. They are coming thick and fast out of the Macquarie conference. So you touched on JB Hi-Fi. They did say that sales are slowing. They highlighted a bigger slowdown in the good guys, which is probably aligned with what we saw at the last half-year reporting period, where these big ticket items are struggling more than the smaller ticket items. So the fact that they're saying that things are slowing as expected, they haven't slowed a lot. Like-for-like sales down 0.1%, so not a huge number. I would have thought that's well and truly factored into the price of JB Hi-Fi. The stock's trading sort of sub 10 times earnings. We're all expecting a decline in earnings over the coming 12 to 24 months. So I would have thought this is well and truly captured in the price, Nadine.
Okay, so captured in the price of JB Hi-Fi. Just to touch upon Flight Centre as well. We've had a lot of these updates coming from the travel space upgrading, but do you reckon as well that this 2.9% upgrade coming from Flight Centre might already be in the price?
Yeah, looking at it now, Nadine, it's only up 0.4%, so well and truly. I mean, that's a small upgrade in terms of Flight Centre. There's been a couple of brokers that have changed their numbers in the past week on Flight Centre as well, so taking it to a more favourable setting. So you're right, you make a really good point about the momentum happening in the travel space at the moment. We've seen it from corporate travel, we've seen it from Hello World as another one in that space, a smaller competitor, Flight Centre. They've had a number of earnings upgrades, and Flight Centre has got good momentum in their business. So clearly travel is bouncing back pretty hard, and these guys are capturing the lion's share of that upside. So 2.9% upgrade in earnings today is probably pretty negligible given where the share price has run from.
Okay, back, I suppose, to the updates that we've been getting as of late, and we're continually talking about discretionary versus staples. I thought it was really interesting yesterday in Woolworths update, Brad Banducci lamenting, really sticky inflation in some areas. He said not food inflation, so I think this speaks to the Reserve Bank's action yesterday. But he said frustratingly sticky inflation in other areas of the business. And the other point is he said that customers are trading down, and that's likely here to stay. What did you make of the update coming from Woolworths? And does that change sort of your thinking about the mix in portfolios between discretionary and retail and staples?
Yeah, so just setting the backdrop a little bit more broadly. So Woolies trades on obviously a great retailer that we all need to go and use, but they're trading on sort of 27, 28 times earnings. You made mention of JB Hi-Fi, that's trading on 9.8 times earnings. So there's a major disparity between the pricing of these consumer staple stocks and the discretionary retailers. So the Woolies sales update yesterday, I know he's spoken to sticky inflation, but that the rise in prices are driving a better sales outcome at Woolies. So their like-for-like sales are up over 8%. Coles are up 6.5%. So they are driving that increase in sales. My concern around those is speaks to the point I just made around relative valuation. You can see it on the chart on the screen in front of you, just around Coles and Woolies are trading at really high levels. Woolies is about 14% above from a valuation point of view versus its 5-year history. Coles is about smack on, so it's on 21 times. But then you look at Metcash, it's trading on 12 times. So my preference in that space is Metcash. We've written about it in our Market Matters report this morning. Just our caution around Coles and Woolies, particularly Woolies after the current run in share price.
Okay, so preferred in the consumer staples space is Metcash. That's something for us to take away from this. James, what's going to happen with gold? I mean, it sort of broke out. Is it back in its box? Is it ready for another leg up? I know you guys at Market Matters are long gold, but there's just so much uncertainty in terms of, the economy versus central banks. It's a hard picture to make clear.
And that's why you buy gold, Nadine, because of this uncertainty that you made mention of. So, we saw it yesterday locally with the RBA surprisingly raising interest rates. There was 90% probability they would stay on hold, 10% chance of a interest rate hike in terms of market pricing. They went and hiked. So you're right in terms of the high level of uncertainty in the market at the moment, and that speaks to why you go out there and have an allocation to gold. Is inflation going to be, have we cycled off the top of the inflationary pressures? Probably, but there's some areas that are going to remain sticky. The US dollar, as we often speak about, is a real key influence on the gold price. That's trading within a range at the moment, so a little bit more difficult to get a handle on the US dollar. But to me, gold is, I think it will have a sustained break above 2000. It obviously broke out above that level last night, and I think it's just a matter of time before we see a sustained break and hold above the 2000 an ounce level, and sort of pushes up towards that 2300. I think that will really get the gold sector in Australia ripping, and I think that's something that we're already positioned for, Nadine, as you made mention of.
Ripping. All right, so just remind us, for those of our viewers right now that don't hang on every word that we say 24 hours a day, what are your preferred picks?
So it's in large caps. I know it's a bit boring, but Newcrest obviously under takeover. We think there's more value to play out in terms of the obviously Newcrest operationally, but also with the bid playing out from Newmont. We own Evolution as well. We think that's a really interesting mid-cap gold play. St Barbara is a little bit of a prickly stock that we have in one of our portfolios that we're probably less keen on at this point in time. But Ramelius is the other one I'd highlight. They presented at a conference we held yesterday. They've had some really, sticky cost pressures in their business, but they're starting to move on from those. So starting to get those under control. So Ramelius would be the other one, perhaps we're looking at the moment.
Okay. When we talk about all this uncertainty, when we talk about this wall of worry that markets are climbing this week in particular, and it will continue because we've known for quite some time that every data point is just so, instrumental in terms of where policy will head. How defensive are you in your portfolios? I mean, are you more defensive now than when, or are you increasing the defensive posture?
Yeah, from a broad brush perspective, we're more defensive than we were a month ago. So I'll give you a few examples. In our flagship growth portfolio, we've slightly reduced our technology holding. We're still overweight that space. We have been for sort of 6 to 9 months, and that's been a really strong underpinning factor of our performance. But we've started to rotate, reduce our exposure to tech, and increase our exposure in cash. So cash sits at sort of 11% in that portfolio, and we've bought a few more defensive names. Our income portfolio, we've taken a few things off the top. So we've trimmed AGL, Wesfarmers, Telstra. We sold out of Transurban. So again, we're putting money back into holding a higher cash position. I think it's around 7% in that portfolio, but also more into the fixed income space. I think there's interesting value in the in the fixed income and hybrid market, Nadine. So we are taking a more defensive stance at the moment. I think it makes sense from a seasonal point of view. The market's obviously been hot in the last couple of months. It's been a cracking start to the year from a calendar year perspective, but I think now's the time, preferably a couple of weeks ago, was now the time to increase cash and flexibility going into confession season, into full year reporting as well, Nadine.